New data out today showed pending U.S. home sales fell in January as elevated mortgage rates impacted demand. Pending sales declined nearly 5%, which was way steeper than estimates. Joining me to discuss is Tripp, Nuveen Real Estate's Global Chief Investment Officer, Head of Investments. Carly, I mean, the lack of supply combined with these higher rates continues to be an issue for people looking for an on-ramp into residential. But then you've got the office market, which is confounding investment as well. What do you do here?
Yeah, what do you do? That's a great question, John. Thanks for having me today. So on the residential market, you know, it's kind of like no new news. However, what's interesting is that the consumer is really starting to explain, I guess, their tolerance for mortgage rates, right? In December, we saw really strong numbers. Mortgage rates had come in about 50 basis points, bouncing around 6.5. As they have steadily come up since then and hover above 7, consumers do not like that, right? And so we're seeing the results of that in pending home sales. So we expect that that is not going to improve. Inventory will remain low until rates come around 6%, in which case your cost to own versus cost to rent margin really starts to shrink.
How does retail look?
Retail's doing amazingly well. So retail has been, you know, the underdog of the last decade. And what we're seeing at our centers is increased activity, a lot of demand, increased sales. The consumer is obviously very resilient and strong. That is accommodating to retail spending. 80% of retail sales do involve a physical store, which is a positive for our centers. And not only that, but there's no new supply added to retail. Over the last 5 years, about 130 million square feet of retail has been converted to other uses. So it's really been underinvested in. So the outlook for retail is very strong.
So I keep hearing on office, which many people are worried about, that there's the relatively new Class A office. It's actually doing fine. And then there's the other stuff, which is some kind of a disaster waiting to happen. How does it look from your vantage?
Yeah, absolutely. Winners and losers. Even if you look at the public REITs, the large public office REITs, you can glean a lot by their return to office stats. The office REITs that have really super high quality portfolios are above 90% return to office. That's really strong. Those with lesser quality portfolios, obviously in the 60% range, right? So it's incredibly bifurcated, and we've seen a flight to quality. But if you walk around a city like New York, activity is back. That said, structurally, long-term, we do not need as much office space as we have, which will kind of create this scenario of the haves and have-nots.
I keep hearing the best as well out there is in industrial, some of the strongest performance. How are you seeing that reflected in the market?
Industrial's been incredible. It has performed exactly as real estate should perform. Income has outpaced inflation, right? Which real estate is expected to be an inflation hedge. That's why it's such a great diversifier to a portfolio. And so we continue to see incredibly strong demand for industrial. Supply has slowed. That was the concern pre-pandemic. However, due to, you know, lack of construction lending, lack of financing, just generally speaking, bottlenecks in the construction system, we expect that demand is just going to continue to flow. E-commerce spending is not going anywhere.